Gold is trading at $5,000 an ounce this morning, and the Fed hasn't done anything yet. That's the part that should stop you, not the number itself. People have been watching $5,000 approach for months. What should stop you is the timing. Gold is sitting at $5,000 per ounce on a day when the Federal Reserve is still holding rates at 3.75%. Real yields are above 1.8%, and Jerome Powell hasn't said a word. The price got here without a rate cut, without a pivot, without any of the traditional catalysts that are supposed to drive gold to these levels. So the question isn't whether gold has had a good run. It's what is actually holding it here, and what happens to that in the next 6 hours. That's what this session is about. Before touching anything intraday, it's worth establishing why the price is where it is structurally. Because if you don't have that foundation, the FOMC becomes noise instead of signal. 3 things explain the $5,000 price level, and none of them are speculative. The first is central bank buying. China has purchased gold for more than 15 consecutive months. Chile added gold to its reserves for the first time in decades. Analysts project roughly 800 tons of net central bank purchases across 2026. This is not retail enthusiasm or momentum trading. This is sovereign demand. Governments and central banks converting dollar reserves into gold at scale. They are not doing this because of a trade. They are doing this because of a structural view about the dollar's role in global finance over the next decade. When that class of buyer is consistently on the bid, it changes the floor. The second is physical availability. COMEX registered gold, the metal that is actually available for immediate delivery, sits at roughly 16.76 million ounces. That sounds like a lot until you put it in context of current price levels and trading volume. Tight registered inventory at high prices means the spread between paper contracts and physical metal is compressed. That matters because if a large number of contracts stand for delivery at the same time, there isn't a comfortable buffer. This creates structural upside pressure that doesn't require any macro trigger to sustain. The third is a supply-demand imbalance that the World Gold Council has documented clearly. At current prices, the world wants more gold than mining production can supply. ETF inflows have turned positive again this month, which means institutional money is not reducing exposure at $5,000. They are adding to it. So when someone says gold at $5,000 is irrational, the data says otherwise. The price reflects ongoing, documented demand from actors who are not speculating. The question isn't whether the price makes sense. It does. The question is whether it can hold into and through what happens today. What would it take to actually break this market lower? Think about that for a moment, because the answer matters before we get to the Fed. Today's pre-Fed inputs are worth knowing, but none of them are moving the needle much on their own. The DXY is at 99.56, essentially flat, trading in a range of about 14 basis points. A weaker dollar supports gold, a stronger one presses against it, but flat is flat. No directional signal today from the currency side. 10-year Treasury yields are at 4.18%, down 2 to 3 basis points. Real yields, what you earn after stripping out inflation, are holding around 1.80 to 1.85%. Gold pays nothing, so every basis point of real yield is an argument for holding bonds instead. The direction today is slightly lower yields, which is slightly supportive, but slightly is the right word. This is not a rate move that changes anyone's position. PPI for February is expected at plus 0.3% month over month, which would be cooler than January's 0.5%. A softer PPI reading removes one argument for the Fed staying hawkish. If it prints hotter than expected, that argument returns, and gold will feel it quickly. The tape on COMEX confirms the picture. Moderate selling at the open, buyers stepping in near $5,000, no large block activity, bid-ask spread normal. The market is positioned and waiting. Volume is around 18,000 contracts in early trading, steady but not aggressive. If the PPI comes in hotter than expected, where do you think gold goes before the Fed even speaks? It's a genuine question, because the answer tells you something about how much the market has priced in a soft number. Everything so far leans mildly in gold's favor. None of it is a catalyst. The only thing that changes the session is Powell. Markets expect no rate change today. The Fed funds rate stays at 3.75%. That decision is already priced and will not move gold by itself. What moves gold is the tone of the statement, the dot plot, and what Powell says at the press conference starting at 6:30 p.m. Eastern. The dot plot is the Fed's own projection of where rates will be at the end of 2024, 2025, and beyond. Each Fed member submits their forecast anonymously, and the distribution gets plotted. If the dots shift toward fewer expected cuts, that means the Fed as a body believes inflation is stickier than it thought 3 months ago. If the dots hold or soften, the Fed is signaling patience or growing concern about growth slowing faster than inflation is falling. 2 scenarios, and they have clear outcomes for gold. Scenario 1. Powell is dovish. He expresses concern about slowing growth, acknowledges that inflation is cooling, the PPI supports that reading if it prints soft, and signals that the Fed is patient and data-dependent with a bias toward eventually cutting. In this scenario, gold moves quickly toward $5,100. The dollar softens. Real yields compress. This is the scenario the gold bulls are currently positioned for, and the order flow near $5,000 this morning suggests they are holding those positions into the event. Scenario 2. Powell is hawkish. He emphasizes that inflation, partly driven by elevated oil prices and ongoing geopolitical friction, remains too high to move toward cuts. He signals that 3.75% needs to stay in place longer than the market expects. In this scenario, real yields likely tick up, the dollar firms, and gold tests support at $4,950 to $4,980. The Fed is not walking into an easy statement today. Growth indicators have been softening. Oil prices have remained elevated, which feeds directly into services inflation and logistics costs. U.S.-Iran tensions and the broader West Asia conflict have kept energy markets unsettled. Powell has 2 real pressures pulling in opposite directions, and he has to publicly choose how to weight them. That tension is not manufactured. It is the actual environment. Which scenario do you think is more likely? After everything you've just heard, tight COMEX stocks, ongoing central bank buying, softening yields, the geopolitical backdrop, where do you put the odds? The chart gives you the framework to act on whichever scenario plays out. Support sits at $4,950 to $4,980. This is where buyers have consistently appeared on pullbacks, and the volume profile on the 30-minute chart shows significant prior activity concentrated in that range. If price drops there and holds, dip demand is intact. If it breaks through, the move accelerates. There isn't a dense volume node immediately below it. Resistance is at $5,100. That is the clean upside target in the dovish scenario. Between here and there, the $5,000 to $5,010 area acts as the gravitational center of the session, the high-volume node where most of today's contracts have already changed hands. Price is likely to stay close to this zone, absorb, and coil until the statement drops. VWAP, the volume-weighted average price, is the session's fair value line. As long as gold trades above VWAP, the short-term bias is bullish. Below it, the bias inverts. This is not a prediction. It is a lean, a way to interpret whether the buyers or sellers are in control of the order flow at any given moment. GDX, the gold miners ETF, is at $94 today, moving with gold at a correlation of roughly 0.85 to 0.90. Miners are leveraged to the metal. A 0.5% move in gold typically produces a 1 to 1.5% move in GDX. Watch it not as a trade, but as a confirmation. If gold moves after the FOMC and GDX doesn't follow, that divergence is worth paying attention to. 3 things are worth keeping in mind as a retail trader going into this event. First, size small. Not because the directional analysis is wrong, but because the execution window after a Fed statement is measured in seconds, not minutes. The initial spike in either direction will be fast and the spread will widen. Chasing that move is where the analysis gets expensive. The edge is in having a position entered before the event with a defined level, not in reacting to the headline. Second, know your exit before the statement drops. The levels are already on the chart: $4,950 on the downside, $5,100 on the upside. Anyone holding a position into the FOMC should have decided before 6 p.m. at which price they are wrong. That decision gets much harder to make rationally in the 90 seconds after Powell's first sentence. Third, the macro structure does not change today. Central banks are still buying. COMEX inventory is still tight. ETF flows are still positive. In the hawkish scenario, a pullback to $4,950 is a pullback within a structural bull market. That context doesn't protect a trade. Stops exist for a reason. But it does determine whether a setback is worth holding through or worth exiting. Knowing which situation you're in before the event is part of the preparation. Gold at $5,000 is not waiting for the Fed's permission to be here. It arrived because of forces the Fed does not control: sovereign buying, physical supply constraints, a structural global shift away from dollar-denominated reserves. Today's event will create movement. It will not change any of that. Watch the levels. Know your scenario. Size accordingly. One last thing. Everything in this video is for educational purposes only. None of it is financial advice. Before making any trading or investment decision, do your own research and take full responsibility for your conclusions. That's not a disclaimer. It's just the only honest thing to say.